In this video, we will learn the most common chart patterns. I will show you how they look like, how to spot them, and of course how to trade them. Let's start with the triangles. There are three types of triangles: the symmetrical, the ascending, and the descending. The symmetrical triangle needs two converging trend lines, one decline and one rising. It can form in both during uptrending markets or downtrending markets. It shows a temporary stop in a form of consolidation, and the market is expected to resume the main direction. So if the main trend was up, the symmetrical triangle is expected to put the price back into the uptrend. If the main trend was down, the symmetrical triangle will put the price into a downtrend continuation. Next is the ascending triangle. This characterized by a straight line across the highs and by an ascending trend line across the lows. The ascending triangle usually forms during uptrends, and the market is expected to move in the same direction. And the last one is the descending triangle. We find this during downtrending markets in most cases. A straight line needs to connect the lows of the market, and the downward trend line is needed to connect its highs. After a descending triangle form, the market is expected to move further down. They are both short-term in duration, and after their completion, the market is expected to move in the predominant direction. So if the trend was up, after their completion, the market is expected to move upwards. If the trend was down, after any flag or pennant form, the market is expected to move in the same direction. And the last and most common visible patterns on the chart are the double tops and the double bottoms. These are both reversal patterns, and they usually change the trend. If the market was in an uptrend, when a double top forms, the market is expected to change direction and move in the opposite side. And respectively, if the market was trending down and a double bottom forms, the price is expected to reverse the trend and create a new uptrend. The double top is characterized by equal highs, and the double bottom is characterized by equal lows. When the double top forms and the recent low breaks, that means the market changed direction and the uptrend now ended and a downtrend began. And when the last high breaks during a double bottom, the market shows that buyers are stepping in to push the price even higher, and that the downtrend formed primarily by sellers is not valid anymore. I will show you how to use the patterns to estimate take profit areas. If we look at the symmetrical triangle, you can measure the distance between the first high and the first low. You add it at the breakout point, assuming the breakout will occur here, equal distance here to there, and you find out the minimum estimated target. The same method you use to measure the estimated target when an ascending or a descending triangle forms. You add this distance at the breakout point and you find the minimum price objective. You can do the same with the flags and pennants. The distance between the first high and the first low, you add it at the breakout point and you find where the price should move after the breakout. And same with the pennant, the distance from here to there, and add it at the breakout point. If you look at the double top and the double bottom, you can measure the distance between the equal highs to the first low or the first high in case of a double bottom. We call this the neckline of the pattern, and when you add the distance at the breakout point, you can find the minimum price objective. So far we explained how to spot the patterns, how to find the minimum price objective. Now I will explain you where to place your stop loss. In the symmetrical triangle, you are buying here with a target up there. The stop loss should be placed below the last low. With the ascending triangle, if the breakout occurs here and you buy in the market, your stop loss should be placed below this low. And if you are selling the descending triangle, from the breakout point, the stop loss should be placed above the last high right here. The exact same method is used for the flag and pennants. A stop loss during a bullish flag goes below this low, and during a bullish pennant below this low here. If you will trade the double top and you want to sell the market right here, usually a stop loss is placed above the last high. And when you buy the double bottom at the breakout point, a stop loss is placed below the last low. Just remember, patterns don't predict 100% the moves in the market, they simply increase the probability in our favor. Look at this flag pattern. It found on the Nasdaq chart on the 5-minute time frame. The market was in an uptrend with higher highs and higher lows, and here it stopped, started consolidating, and it formed the bullish pennant. At the breakout point, traders could have entered the market with a buy order with their stop loss below either this low here or below this low down there. Regarding the take profit area, you simply measure the price range between the breakout and the last low, like I'm doing here. You duplicate it and you add it at the breakout point. If we draw a straight line at the top, we can see that the market from this point here, it reached the minimum price objective right there. This is an example showing a descending triangle during a downtrending market. See where the price broke outside of the triangle? The entry could have been right there, the stop loss above the last high, and this take profit is the minimum distance between this low and this high added at the breakout point. That means the price level right there. Here are some common mistakes beginners make really often. The first, they are forcing patterns where they don't exist. The second, they are ignoring the trend. Patterns are easier to read in context rather than in random areas on the chart. And the last common mistake is that they often ignore risk management. Let me tell you something here. Even the perfect patterns can fail in the market. Here is a simple exercise for you. I want you to open any chart you want, like the Euro US dollar. You can choose your time frame, and I want you to look for one triangle, one flag or pennant pattern, and one double top or double bottom. Using the drawing tools, draw the pattern on the chart and note where the breakout or reversal occurred and what the target would have been. Repeating this on different markets to start recognizing patterns naturally. To summarize, first, chart patterns are repeated shapes created by prices. They help predict continuations or reversals. At first, just focus on a few simple patterns like the triangles, perhaps the double tops and double bottoms. Always remember that patterns work best in context with the overall trend and levels. In the next video, we will introduce simple indicators like the moving averages, the RSI, and the stochastic.